Forget the indicators, forget the moving averages, the RSI, the MACD. Traders who master one concept, just one, consistently outperform traders with 20 tools on their chart. That concept is support and resistance. And by the end of this video, you're going to see the market completely differently. Section 1. What support and resistance really are. Let's start with the core idea. Support is a price level where buyers have historically stepped in and pushed price back up. Resistance is a price level where sellers have historically stepped in and pushed price back down. Think of it like a floor and a ceiling. Price drops, hits the floor, bounces up. Price rises, hits the ceiling, gets rejected back down. But here's the key thing most beginners miss. These levels exist because of human psychology, not magic. Traders remember where price reversed before. They place orders at those same levels again. And that collective memory is what makes the levels hold. When price approaches a support level, buyers who missed the last move say, "I'll buy here if it comes back." Sellers who bought at the bottom say, "I'll take profit here." All of that order flow clusters at the same price, and that's what creates the bounce. Same idea in reverse at resistance. Sellers who miss the last drop say, "I'll sell here if it comes back up." Buyers who are in profit say, "I'm taking profit at this level." The orders pile up, price gets rejected. That's it. Support and resistance is nothing more than price memory. Section 2. How to draw them correctly. Now let's talk about how to actually draw these levels, because this is where most traders get it wrong. The number one mistake is being too precise. Beginners draw support and resistance as thin lines, then get frustrated when price doesn't stop exactly at that line. Here's the truth. Support and resistance are zones, not lines. Price doesn't always respect a single number to the pip. It respects an area. So when you're drawing levels, think of them as rectangles, not lines. Give them a little breathing room above and below. Second mistake, drawing too many levels. If your chart looks like a cage, you're doing it wrong. You want the key levels, the ones where price has reacted multiple times with strong, decisive moves. 3 or more touches makes a level significant. 1 touch barely counts. Here's how I draw them. Zoom out to the daily chart first. Find the obvious swing highs and swing lows. The points where price clearly changed direction, mark those. Then zoom into your trading time frame and look for any additional levels that have been tested recently. The more times price has reacted to a level and the stronger those reactions were, the more important that level is. A level where price bounced 3 times with big rejection candles is far more powerful than one that barely held once. One more thing, levels flip. A support level, once broken, often becomes resistance. And a resistance level, once broken cleanly, often becomes support. This is called a role reversal, and it's one of the most reliable setups in all of Forex. Section 3, Confluence Zones. Now here's where this gets really powerful, confluence. Confluence means multiple factors lining up at the same price level. On its own, a support level is good, but a support level that also lines up with a round number, a previous weekly high, and a Fibonacci retracement, that's a high probability zone. The more reasons price has to react at a level, the more likely it will. Here's what I look for when building a confluence zone. First, is there a clear structural level? A major swing, high or low? Second, is it near a round number like 1.1000 or 1.0850? Big banks and institutions place large orders at round numbers. Third, does it line up with a level on a higher time frame, like the weekly or daily chart? When you find a zone where 2 or 3 of these factors overlap, that's where you focus your attention. That's where price is most likely to react. And that's where your setups will have the highest probability. You don't need to force confluence. If it's not obvious, it's not there. The best levels jump out at you. Section 4. Entry, stop loss, and take profit placement. All right, you've identified your level, you've got confluence. Now how do you actually trade it? First, you wait for confirmation. Do not buy just because price touched support. You need to see the market show you that buyers are actually stepping in. That means waiting for a bullish candlestick signal. A hammer, a bullish engulfing, a strong close off the level, something that tells you price was rejected, not just paused. Entry. Once you have your confirmation candle, you can enter on the close of that candle or on a small pullback into the zone on the next candle. Don't chase. If price has already moved 30 pips away from your zone, the setup is gone. Stop loss. Place it below the support zone, not at the zone below it. You want to give price enough room to breathe. If price breaks cleanly through your stop, the level has failed and you don't want to be in the trade. A tight stop right at the level will get hunted. Take profit. Aim for the next area of resistance above your entry. That's your natural target. If the next resistance level gives you a risk-to-reward ratio of at least 1 to 2, meaning you risk 50 pips to make 100, the trade is worth taking. If the target is too close, skip it. And remember, not every touch of a level leads to a trade. Sometimes there's no clean confirmation. Sometimes the risk to reward isn't there. That's fine. Pass on it and wait for the next one. Section 5 and 3. Real trade examples. Let's look at 3 real chart examples so you can see exactly how this plays out. Example 1. EUR/USD daily chart. Price has been in a downtrend, drops into a zone around 1.0800, a level that previously acted as support back in January. There's also a round number there. Price touches the zone and forms a hammer candle. The next candle is a strong bullish close. Entry just above the hammer's high, stop below the wick, target at the next resistance at 1.0950. Clean 1 to 2.5 risk to reward. Price ran to target within 4 days. Example 2. GBP/USD 4-hour chart. Price pushes up into a zone at 1.2700. Previously a major support that was broken. Now it's acting as resistance. Classic role reversal. Price hits the zone, forms a bearish engulfing candle. Entry on the close. Stop above the zone. Target at the next support below. Again, over 1 to 2. Example 3. A trade to skip. USD/JPY. Price approaches a support level, but the candles going into it are strong and bullish, with no signs of slowing down. No rejection wicks, no indecision candles. This is a breakout, not a bounce. No confirmation means no trade. Sometimes the best trade is no trade. That's the discipline. You don't take every touch. You take the ones that confirm. Support and resistance. That's the foundation everything else is built on. Learn to draw these levels correctly, look for confluence, wait for confirmation, and you'll have an edge most retail traders don't. If this clicked for you, smash that like button. It genuinely helps the channel grow. And if you've been drawing support and resistance wrong this whole time, drop a comment below. I want to know what changed for you. Next video, we're going into risk management. The reason 95% of traders blow their accounts even when their analysis is right. That one's going to hit hard. Subscribe so you don't miss it.